And then if we look at a more long-term chart of that, the silver price as a percentage of gold, if we go back to 1980, yes, that was around 6.5% of the price, which takes it to around that 15-to-1 level. So you do the maths. If we go to $10,000 gold, silver could be at 1,500, 15-to-1, or it could be a bit less, but it will be a lot higher than we're now, and it's going to outperform gold because it does so in major bull markets in precious metals. The one in the 70s and the one from 2001 to 2011, it did so.
Mario Innecco didn't mince words. Short-term noise is irrelevant when you're living through a once-in-a-century monetary reset. He stressed that gold's recent pullback, which had traders panicking, didn't even register on the long-term charts. That's because what's unfolding isn't just another market swing, it's a structural failure of fiat currency itself. Every major paper currency, not just the dollar, is in decline. After months of equities outperforming gold, the trend just broke down a bearish wedge, signaling that capital is once again shifting toward hard assets. Silver, in his view, is exhibiting classic early-stage bull market behavior. Wild moves aren't warning signs, they're confirmations of strength. Spiking to $48, crashing to $46, then ripping back toward $47 is precisely what silver does when it's coiling for a major breakout. Using Michael Oliver's method of measuring silver as a percentage of gold, Mario pointed out that we're still nowhere near historical peaks. In 2011, silver hit 3% of gold's price. In 1980, over 6%. Today, it's far lower, meaning the real move hasn't even started. If gold were to reach $10,000, a plausible scenario in a currency crisis, a return to a 15-to-1 ratio puts silver near $1,500. That's why Mario argues that traditional portfolio thinking is dead. Even Wall Street is quietly admitting it. Morgan Stanley has already shifted from the standard 60-40 split to a 60/20/20 model that gives gold equal footing with bonds. But Mario believes that's still too conservative. His preferred structure? Flip the script: 60% gold and silver, 40% equities. Bonds, aside from the shortest-term liquidity instruments, no longer serve their historical role. Before we dive deeper into the discussion on gold, silver, and the unfolding changes in the global monetary system, don't forget to like this video, subscribe to the channel, and hit the bell icon so you stay updated with every new insight.
And as for yesterday, yes, some of you might have thought you kind of jinxed gold. You said there wasn't going to be much of a correction on the way to 4,300. But don't forget, I showed you a weekly chart. And this chart that I've brought up again here is from this morning. I updated it. And as you can see, that correction yesterday doesn't even register on this chart. So what I'm trying to say, yes, short term there will be ups and downs, but I've said this many times: hold on to your gold and silver for dear life. I saw someone on X, I forget his name, and I'm sorry that I'm not giving him I'm giving him the credit, but he's got like a Russian name. He's a Western analyst. And he said, well, people keep asking me what innings we're in the gold bull market. And he said, it doesn't really matter. He said, we are in a monetary crisis. And I agree with him. It's like, yeah, we're like in Zimbabwe, Venezuela, or Brazil when they had their currency crises. Would you want to hold on to those currencies? And it's the same thing with gold, because gold is the only way to protect yourself against the currency crisis of the major reserve currency, i.e. the dollar, because technically the dollar used to be as good as gold. So we have to do like a regression theorem analysis. So that's the only way to protect yourself. And it's not just the dollar, of course, that's going to go. It's all fiat currencies. So that's that. So I've got here another Dow gold ratio chart. It's a weekly one and it's more short term. So you can see what's really happening now. We had a rally in the Dow relative to gold since April, but now we've broken this rising wedge, which is very bearish for the Dow versus gold. And it looks like we're going to dip a lot lower in the short term. Of course, 1-to-1 or less than 1-to-1 is probably 2, 3, 4 years away, or who knows, it could be very quick. But we will know when it happens because it will be 1-to-1 or even less. That's the way I see it. So let's look at silver. Because silver is doing well too. We traded to 48 yesterday, and then we corrected below 46. And this morning, as I speak here, silver is at 47.30, up 33 cents. Gold is at 38.60, up $4. I think gold went down to 38.19. So yeah, the volatility is quite pronounced in the precious metals, and usually volatility in precious metals goes up as the market goes up. It's the inverse of the stock market. But yeah, so this, let's go back to the silver chart. Yeah, so it's the percentage of silver, the price of silver as a percentage of the price of gold, right? And Michael Oliver looks at it like this, and I think it's a good way to look at it. And as you can see, we're still in breakout mode, and we're still far away from where we were back in 2011. I think the gold-silver ratio got down to like 31, and as you can see, the silver was just over 3% of the price, which makes sense. And then if we look at a more long-term chart of that, the silver price as a percentage of gold, if we go back to 1980, yes, that was around 6.5% of the price, which takes it to around that 15-to-1 level. So you do the maths. If we go to $10,000 gold, silver could be at 1,500, 15-to-1, or it could be a bit less, but it will be a lot higher than we're now, and it's going to outperform gold because it does so in major bull markets in precious metals. The one in the 70s and the one from 2001 to 2011, it did so. So we're still early days here for silver, I would say. And with that, so yeah, the 10-year is at 4.1. It's still under control right now, but we need to keep an eye on this. It could change very quickly. The 30-year is at 470. But ultimately, I would say look at these assets like stocks, bonds, in terms of gold, because it's going to become more and more important. We are seeing that even Wall Street, i.e. Morgan Stanley, is looking at gold now. The 60-40 stock bond portfolio now is a 60-20-20, and the new 20, the 20 being gold, and the 20 being also bonds. And I think that's probably going to become more like 60-10-30, or I would get rid of the bond part, actually, maybe with the exception for very short-term maturities like 3 months. Yeah, and I would actually make it gold and silver 60 and the rest of the stock market maybe 40.
Mario Innecco argues that the Dow-to-gold ratio, a century-old barometer of monetary health, is quietly signaling that another great financial reset is imminent. He walks through the past 100 years to show how this ratio has collapsed twice before, each time marking the violent end of an over-leveraged credit cycle. In the Great Depression, it fell from 20 to 1 to 2 to 1 as stocks crashed and gold was revalued. In the 1970s inflation crisis, it plunged again from 26 to 1 to nearly 1 to 1 as gold exploded from $35 to over $800 an ounce while equities stagnated. Both episodes were followed by renewed growth, but only after gold restored monetary equilibrium. Now, Mario says we are witnessing the beginnings of reset number 3. After peaking around 45 to 1 in 1999, the ratio has been bleeding lower for 2 decades despite relentless central bank intervention. Each bailout and stimulus package merely slows the descent, it doesn't reverse it. With the ratio now rolling over decisively, he believes the final compression phase could unfold within the next 3 to 4 years. If history repeats, 1 ounce of gold may soon buy the entire Dow once again, not because stocks soar, but because gold is revalued as the only refuge left in an age of terminal credit expansion. Let's get back to the interview.
And I think the Dow gold ratio chart is a really good way to look at it, especially the monthly one going back over 100 years, as you can see here now by this chart. So that's how many ounces of gold you need to buy 1 Dow Jones Industrial Average. And you can see that I've got reset 1. Well, that happened in I think it was 1932 or 33 or thereabouts. And the Dow gold ratio dropped to around 2. So in 1929, it topped just around 20. That's when the price of gold was $20.67 per troy ounce. Of course, there wasn't a price of gold because gold was money at the time, and the Dow went up to I think almost 400, so it was like 20 to 1, and then we had the 29 crash, and the final bottom in 32. So that's when things reset, and then Roosevelt came in, devalued the dollar, revalued gold in 33. So this is the reset period is a period of great monetary, financial, economic, and even social convulsion, and I think we're right in it right now. So let's move forward. After that first reset, what the reset does, it allows the credit system to restart again. Yes, the Great Depression led to loads of bankruptcies. People unfortunately going broke, and then things started picking up again. Of course, it wasn't a straight line, and by the year 1966, we had another post-war credit boom, and I think the Dow topped, the Dow gold ratio topped around 26, and I think the Dow topped probably around 1,000, I think. And then for 14 years until 1980, it pretty much went sideways, above and below that level. And the reason this ratio dropped from 26 to basically 1 in 1980 was that the Dow went sideways, or maybe even some stocks went up a bit. But gold went from $35 per troy ounce to $887.50, which was the high in January 1980. And that completed the reset. The debt to GDP at the time was 35%. Yes, there was a big recession, a double-dip recession in the early 80s. Reagan took over and things changed. And ever since then, we've had a massive boom, financialization boom. And technically, though, this credit boom that started in 1980 ended in 1999, 2000, late 1999, when the Dow Gold ratio topped just around 45, as you can see here. And ever since then, it's been going down. Yes, there was a rally, a correction back up when they threw everything at it to save the system. And by that I mean loads of QE, loads of borrowing, trillions and trillions upon trillions. You can see they did it again in 2020 when things were starting to crash. But now, as you can see, and this is a monthly chart, of course, we're keeling over. And I don't think we have much time. And by that I mean about 4 years, I would say, because if you look at the 1980 reset, we saw the Dow Gold ratio rebound from the mid-70s up until, let's say, well, I think it was around 74 to 76, sharp rebound. And then it dropped, and it took 4 years for that drop to occur. And I think we are keeling over. So it could be 3 to 4 years from now, and that would take us to the late part of this decade. Some people see gold continue to go higher up until 2032. Who knows? But I think reset number 3 might go past 1. And what will that mean? Well, that will mean, for example, if we go to 0.75, that you will need 0.75 or 3/4 of an ounce to buy 1 Dow. If it goes to half, that means you need half an ounce, and so on. At what level will we be in terms of the Dow and gold? Well, it's difficult to say, but I tend to think it's going to be a lot higher for gold, because they're going to keep inflating the system, because they can. In a fiat currency system, they can. And there's no stopping them, because politicians, they want to be reelected. So they will always lean towards more inflation. And we're seeing, despite the fact that Trump hasn't been allowed to sack Lisa Cook, that Trump has a lot more influence now.
Real wealth isn't defined by fiat returns or temporary market swings. It's defined by purchasing power that endures across crises. Precious metals aren't reacting to markets. They're exposing the weakness of the monetary system itself. Gold is quietly reasserting its authority as the universal measuring stick, while silver builds the kind of energy that only appears in the early stages of parabolic shifts. Portfolio models may shuffle allocations and ratios, but in a true reset, only tangible money matters. The transition is already underway, and those positioned in metal aren't betting on price, they're opting out of decay. If gold and silver are no longer just investments but measuring sticks of real value, what does it mean to profit in a monetary system that's in the process of being replaced? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss weekly updates. Thank you for your support, and we hope you enjoy the video.